Consumer price inflation has risen to its highest rate since February last year. Stat South Africa says CPI rose above expectations to reach 6.8%. That's year-on-year growth in December, rising from 6.4%. But analysts still largely expect the Reserve Bank to keep interest rates steady next week and for the rest of the year.
When prices rise too fast, it spells bad news, not only for consumers at the tills, but for the cost of their borrowing. The Reserve Bank uses monetary policy, including raising interest rates, to tame price rises or inflation, which is why the latest unexpected inflation figure of 6.8% is somewhat worrying. Food inflation remains stubbornly high at 12% and the single biggest contributor to overall inflation.
Apart from that, the housing components also came out quite a bit higher than expected, specifically actual rentals and owner's equivalent rent, rose by 1.4 and 1.6 respectively. That's quite a chunk higher than what we expected.
So what does this mean for interest rates? Well, Kruger says the general outlook for inflation this year remains unmoved, with food prices coming down a bit, and she sees the Reserve Bank keeping rates steady.
I think we will have a lot of cautionary type talk from the bank, but if you bring the other factor, and that's economic growth, into the picture, that looks very dismal. And I think if you look at the overall picture, the Reserve Bank will maintain their current stance on monetary policy, i.e. no change in interest rates.
But the rand remains vulnerable to local developments and those in the US. This could move inflation as well as oil prices, which are on a slight rise. Devin Murrigan, SABC News, Johannesburg.